One of the most important investment pivots in the world right now is about the timing of interest rate cuts. If you invest in the stock market or in bonds, if you run a business or you borrow for a home mortgage, that timing is crucial to your decision making. As important is the state of the economy that you live in when those decisions are made. Because if central banks wait too long, the economy could be a mess. Go too early and inflation could re-emerge with more rate cuts down the track. So let's bring in here Jack McIntyre, portfolio manager for one of the world's biggest bond funds, the Brandywine Global Fund, part of the investment giant Franklin Templeton, who's with me. Jack, many thanks for your time.
My pleasure.
It is true that pivot is so important. Everybody thought the bonds in particular, buying bonds was the easiest game in town because as rates come down, bond prices go up, you make a lot of money. It hasn't kind of worked out that way.
No, and I would actually say if you look at the prior decade, post-GFC, before COVID, nobody wanted to be in fixed income. It didn't pay income. We went through a lot of pain in 2022, and now, hey, we're all back to earning a coupon. So fixed income should be back into people's asset allocation. And you're right, inflation is the critical variable. My mindset is that central banks are going to make a mistake. Of the mistakes they're going to make, I'd rather have them hold rates higher for longer, get a little economic pain. We haven't seen any economic pain, but make sure we break the back of inflation.
Because isn't that exactly what we're seeing right now? Everybody's anticipating these early rate cuts from the Fed, from Australia's Reserve Bank, and the reality is that there's so many signs of strength. The employment market remains very, very strong in America and in Australia. The business market, we're just reporting the profits of Australian companies. They've broadly been pretty strong and resilient. There's not as much hurt as you'd imagine when you've seen the interest rate rises as you've seen around the world.
Right. And my thesis is that pain, it's going to be coming. This is all about a lagged effect, and particularly in the U.S., what we have this cycle, what's different this cycle is the fiscal. I mean, we've lost fiscal responsibility. The government, we're running massive budget deficits. It's pro-cyclical policy. That's going to start to wane, and then what's left is still tight monetary policy. Meanwhile, though, you've had wealth creation through this very concentrated rally in equities. I'm not going to say it's going to end anytime soon, but if there is a little bit of a stumble, that's going to be a big tightening of financial conditions.
Okay, so then what you start to see is almost like false dawns in some ways. Oh, yeah. It's almost as though, yes, it's coming, or no, those employment numbers come out, or we suddenly see the latest inflation numbers, or retail sales numbers, whatever they are. But it seems as though the hurt of higher interest rates is not shared equally throughout our communities or our businesses, for that matter. That's one thing that we're seeing even in Australia right now.
Yeah. And I agree. I'm not going to push back on that because economies seemingly aren't quite as sensitive to interest rates as they have been in the past. You could actually make the argument because for the decade before COVID, central banks punished savers with no rates. Now, hey, you actually earn cash, pays you to be there. It's a competitive aspect. But again, I think inflation, so something has broken. We talk about economic pain. What's broken is inflation. In the U.S., you've gone from 9% to, let's say, 3.6%. That's broken. That's a good thing. That's this sort of a immaculate disinflation.
And yet they still insist on getting it down into their bands between 2 and 3%.
Yeah. And again, though, because the issue is we might get it down there, but will it stay down there? I think personally, so we had the last 40 decades of just one-way trade and rates and inflation. That's probably changed. We're probably in some kind of regime shift, which is not a bad thing. You can still make money in that environment. It just means business cycles might be a little bit shorter than what we're used to over the past 4 years.
So what you're saying, though, is that if you're a bond investor trading the ups and downs of interest rates, or a stock market investor buying the banks or whatever, which are yield-based, that you've got to be very aware that there could be subtle changes. It's not a one-way street that you can simply buy something and sit on the yield.
Yeah, and I agree. Again, it was hard to compete with passive investing because it was on the bond side, because it was sort of you buy bonds and you hold them until they mature. I don't think we're going to see that type of environment. Again, if your time frame is 2 to 3 years, you might just need to think a little bit differently about your bond portfolio. I'm not going to say trade too much, but just realize that those secular disinflationary forces we saw for the last 40 years just might not be in place.
Because we can't be left imagining that even though they are independent, that central banks don't feel some political pressure or even the pressure of the community to bring rates down, to take some pressure off those people who are feeling the impact most.
Yeah, and in the U.S., there's an election, a pretty important election. And The central banks, right, they love to show their independence, but they're going to have some kind of influence on that election because they've got to influence the economy as well. But ultimately, what's going to dictate their policy is that direction that inflation takes. If it does not continue to head lower, then it means that the Fed is going to be on hold, or they're going to push off those rate cuts later in the year. And then it gets a little bit more complicated because it does kind of tie into the election cycle.
Because it does get a bit murky, because if all of a sudden they overstimulate, they bring the rates down too early, inflation suddenly takes off, the employment rate sort of takes off, bringing down the unemployment rate, pushing up wages, then the worst case scenario for a central bank is to have to pivot back the other way very quickly and to start raising rates again into that, because that could cause the real hurt in any economy, be it in the US, Australia or in Europe.